Hello guys, and glad to have you on board again. Today we do have a little bit of volatility, therefore we're going to make another recording today. Don't overexcite yourself, it's just probably today's conclusion is going to be, alright, we need to have a look at what happens, but don't overreact any fucking way. A little bit of a spoiler, of course, but what's important out there is just how we reach out to this conclusion, because that's the goal of this podcast, actually, not just talking endlessly without an endpoint, but basically forecasting things and trying to let you see how on a day-to-day basis I get to draw my own conclusions and what's the process in between to see how recurring this thing is and stuff like that. Anyway, yesterday I promised I would record another educative lesson, so the trading lesson number 2, TL number 2 or something like that, things I've been introducing 2 days ago. We're going to basically restart and reshape the educational content into this YouTube channel with a much more actual rendering with those video stuff and things like that. So I will do it today. That was a promise. So even though we're recording today a daily briefing, we'll do as well an educational session. So plan EURJPY ahead, because obviously I'm doing these things in French and then in English for both cases. So it's a 4 recording day session. It's going to be me in front of the fucking camera for a long time today. Anyway, let's get this thing started, not wasting our time, and see how we can reach out to this conclusion. All right, context first as usual. Today's most important action comes out of initial jobless claims, sorry. So this is once again the job market's derivative numbers. So we still have this huge and profound dichotomy in which we both have people getting to ask for a jobless claim and therefore unemployment checks, and in the same time a global number of people being unemployed starting to shrink, even though we suspect we're not going to get back to where we were previously or pre-COVID. So it's basically people tend to believe that we are going to get back to usual as normal, or back to normal ASAP. I sincerely doubt it. It's probably going to take years, and that's what economists tend to say as well, that the shock we've had is certainly not going to be overwhelmed in just a few weeks, or even less than that, just a few months. But the thing is, it's going to take much longer than that. It's a process that cannot be reversed immediately, but giving some strong reactivating signal is of course really important for the market. The market is not just forecasting what's happening right now or just a week or two for now. It's really plotting months ahead, and therefore all the gains we've had recently in the stock market, even though they might be sounding a lot dangerous and totally stupid, decorrelated from reality and stuff like that, don't be stupid. The market doesn't care about reality. The market is always months ahead. So it's only when the market gets wrong, and deeply wrong, and just totally got it 180 degrees off the table, that generally very, very dangerous price actions can show up. So far, as long as things tend to say that the stock market maybe have been a little bit too early, but still isn't wrong, things should be fine. So it's all about how much do we price in the risk. Remember that market job, or at least core elemental job, is supposed to be balancing good and bad informations to forecast what's most probably going to come. But forecasting, you need to understand that the market doesn't play immediate action. It plays what it forecasts for the future. So markets have been forecasting that we'll get over COVID, and we probably will. But the market doesn't necessarily forecast that we do have a deep recession and high level of unemployment, and that we might not be we might not be back to usual until a few years. So that is the risk right now. We really have gone too fast, and therefore have been piling up the gains that we're not going to get. And in that perspective, some pullbacks are absolutely necessary. Doesn't mean the market will end and the end of the world is down the corner, but most likely that we've took all the risks, and all there is to price in right now is how much of those risks are actually still there. So still a big question, and of course unemployment is one of those big question marks in the US economy. Have we really plotted the right shape in terms of recovery? That's the usual stupid game of whether this is a V shape, whether this is a W, or whatever the fuck people are talking about. It's just not letter related. It's just more about how much risk are we willing to take to consider that this thing will be over? I still believe it will. It's just how long it's going to take, in which I totally disagree with the current market behaviors. All right, fear and greed index, as we always use. As you can see, things are deteriorating a bit. That's exactly what we were forecasting. So things are deteriorating out of the entry into the extreme greed territory. Just remember once again that a year ago we were in extreme fear, so we're totally playing with that stupid dichotomy both ways, both vision of the world, and both are totally fighting each other for 2 years. And right now feels to be like the really positive outcome is totally gaining. But like I said, I doubt it's actually the right answer. I think we do have more of a neutral pace down the road. So I'm really still very cautious with bullish exposition, even though bullish exposition right now is absolutely necessary. Don't be a net seller. That would be totally stupid. It's just that right now I'm totally cautious and mostly looking at covering the portfolio. Eventually, as I'm an experienced trader, some short selling in the process, but still these things don't work out so far. All right, yesterday's intraday session, let's pass on this one. Usual thing, quite of an oscillation as long as the European session is on, and as the European session closes, you can see up the tiny little candles. All right, market goes down, midday session in the US, and as we go back from lunch, bam, okay, things starts to roll out of control at 2 p.m. A huge downside movements, breaking down supports and confirming them by closing at the low points, and we can see that all of the indices have been participating in there. As you can see, not the Dow or the Nasdaq has been different stories yesterday. It's more about everyone goes down, sentiment goes down, prices goes down. So the question is, do we have enough volatility to start trading again? Yes or no? Okay, in terms of indices positioning, okay, global positioning on indices, you can see that the Nikkei has failed of its previous market top. So yeah, this is rare, but this still happens. Those double top structures, I don't really like them. Statistically speaking, market rarely reverses out of double top for a simple reason. I'm going to try making it as clear as possible, but normally double top structures are rare for a simple reason. Okay, when the market tests out the level and builds a resistance out of here, normally when you get to retest the same level few weeks, months later, whatever, okay, that doesn't work out in short term, of course, but when you test out things, normally the context is slightly different, which means the first time you tested might necessarily be different than the way you're testing it right now, a few days, few months later, okay? The context cannot be the same because things are always evolving. So you're testing the same level out of a different context. Normally, prices will rarely reverse 2 times out of the same price with different context. That's the reason why, typically, statistically speaking, double tops are not the most favorable structure when you double test a level, okay? So still, they happen. You know that double top is an existing structure, so even though statistically speaking it's not the most probable, it still happened. So maybe we have a double top on the Nikkei, maybe we'll have one on the S&P 500, but this is not a speculative area, properly speaking. That means we can still trade there, but we need to be really cautious, okay? So anyway, EUROSTOXX is building negative high points. We can definitely see that we're building lower high points in here. Very dangerous way if we go back to support, and I tend to believe that we might be going out there. That feels like the most probable scenario. So confirming the tops that have been made during July, that might be causing quite a pullback within the next few days, but volatility is still so fucking low that the question is whether or not we're actually going to trigger movements back to those supports, or maybe just try to dry out volatility out there and flat consolidate for the rest of the weeks ahead. So it's still all about one thing, the fucking Nasdaq. Okay, if the Nasdaq falls off a cliff, all of the indices will just fall. If the Nasdaq maintains its way up into the bubble, then in that perspective, we might have flat consolidation on all the indices because that's the things we've seen previously. If we have a look at bond market, of course, since the last time we've made those podcasts, a lot of things have happened. We definitely have broken through some major supports in there. Still, we have major high-low points. So don't consider this thing as being bearish right now. It's just like we've built a very dangerous structure, and specifically on the 30-year bonds. We're going to have a look at those in details in this podcast. So yes, some things might be happening into the bond market, and like we said, this is where we don't cheat. We can cheat with the stock market because dumb money just, I mean, whatever, they do what the fuck they want, and they can price in some very stupid stuff. But In terms of bond market, they cannot go out there because it's so much money. Then they're really not even making a move out of these markets, okay? Even with leverage and all the courage they would like to get and all of the stupid, dumb excitement we could get out of Robinhood or whatever, they cannot move the bond market. And I can see that this bond market is getting a little bit more into tension, but don't get me wrong and think about it the way it is, all right? When you get a rising yield, and especially on the long-term bonds, this can be done out of three factors. The first one is the basis Fed rates are rising, which is obviously not what we can expect, at least not for years. The second one might be the risk for default. So in here we're talking about government bonds for 30 fucking years. The US cannot default, but they can print out the money. Okay, so that's what we're pricing actually in here, higher inflation. So I think that the market right now, and especially the smart money, is pricing in inflation or risks for the dollar to be seriously devaluated. Because don't get me wrong, there can be dollar inflation without actually increasing and inflating asset prices. That can be real money inflation by the fact that you're losing a shit ton of money and a lot of dollar value that might be lifting indices in the first place. But if you think dollar going down means stocks going up, fuck me, you really need to learn a lot more than that, okay? It's a lot more complicated than this, and as a US is a net importing country, they import more than they export, means if the dollar falls off a cliff, you're losing purchasing power, and that's a hell of a complex problem into a globalized world nowadays, okay? So don't get me wrong, the dollar going down isn't bullish for stocks. It can be very dangerous at some point, and specifically if we go into overinflation territory, which might be what the smart money is pricing in right now. In terms of US dollar, right, so far not that many big of a move. We're standing still with the DXY, and your dollar is dealing with his resistant area. So we're going to see whatever the fuck comes out of here. Right now, not that many moves, but yesterday was an interesting session though. Anyway, we're not going to go much further in there and try to focus on today's conclusion. So let's get to the charts. All right, first of all, we have a look at correlation because that's going to be a useful territory for today's analysis. Like, remember what we've said previously, double top still is a very tough question for me and a very tough area. I don't really like and fancy the fact trading double top areas, but still, all right? So what I would say is that when it comes to trading indices, we do have plenty of other options. Like you can deal with the US 30, which is the Dow Jones, which isn't dealing with previous market tops. So NASDAQ as well. All I would say is that if you want to trade indices, just forget about the SPX. We're dealing with XPX in this perspective because that's the reference standpoint we want to make those analyses onto, because that's the broadest market representation, whatever. But right now, it's not the most appropriate thing to trade. You might want to trade something else than the S&P 500 because it's so flat and it's so low volatile, and so far we can see that even if we have a little bit of volatility, we're still having a higher high point and a higher low point. So just though theory, it's way too much anticipated to think about bearishness. What I would note in here as well is that we still have this crazy motherfucking decorrelation in which some assets really have gone up when others have gone down, right? Like right now the DAX is negative. So my big question is, who the fuck is right out there? Because I've never seen those decorrelation going up and down in the same places. Normally, those things are supposed to do the same thing. As the US made new historical highs, we should have new highs on the even though there weren't historical highs. Out of this decorrelation structure, this one made new high, this one should do as well. So who's the fucking liar out there? These ones have been breaking major support, these ones have been breaking major resistances. One of the two is lying, and I don't know which one it is. I would tend to say it all depends on NASDAQ, but we'll talk about it later. Okay, so trade something else than the S&P 500, and the big question mark is who the fuck is the liar? Either we're going to have a huge catch up on the European assets and Chinese assets, or these ones are the ones that are right, and we're going to have a huge downside catch up on this one. So we might expect a shit ton of volatility. That's what we need to take out of here. Okay, coming from the S&P 500, 1 hour chart time frame, real easy. First of all, we're going to go daily, highlighting this double top area. Okay, so like I said, very rarely, normally we shouldn't be reversing out there, but first of all, we shouldn't have gone there in the first place. So I don't know what the fuck is going on with the S&P 500, but here we are. I'm willing to trade indices to the downside, but not the SPX just because of these double top. 1 hour chart time frame still frames the same thing. We are into very mature trends. So it is not about time to play the fucking trend follow, but it's also about time to understand that reverses still don't take place because we deal with bullish context. Okay, normally if we want a reverse, we need to retrace back to the context, we need to reverse them, we need to pull back in the context, and after this ranging structure, breaking to the downside. That's how we reverse. But there is so little volatility that I doubt these structures will be respected. So my first assessment is we can V-reverse, which means making a stupid market top and going from bullish to bearish immediately. So I wouldn't call for any trend following in there. Definitely not. That would be way too dangerous. And the market can definitely now start fucking up all the supports one by one until we actually get to some longer term perspective supports, which is the last time we do have built an actual support is this area out there. So if we are on the verge to retrace back to 3,000, that can make hell of a drop. And remember that the market can do it. We've done that in the past. So don't get me wrong, volatility could re-emerge. And it's not because we had just a stupid couple of weeks recently that these things will keep on rolling, okay? It's definitely not granted, and just if anything goes wrong, we'll take that as a pretext to fuck it all up, okay? So it really feels to me like the market can go very rapidly to the downside, just needs a pretext to do it, okay? So just needs an excuse or whatever that is. So just have a look at the news flow, and most importantly, like we said, have a look at VIX and all the factors like yen and all of those derivative risk measurements, yields, junk bonds, and you can see they all flash red today. So can we have a harsh and violent reverse? Yes, we can. The VIX is finally breaking resistances, but can this be just another pullback? I harshly think that it is very probable as well. So I wouldn't call for immediate bearishness and stuff like that, but at that point, covering the portfolio, I'm still covered personally. I never took out the trades. So I'm still 100% covered, but my question is whether or not I'm going to reinforce portfolio's exposition to the downside. At that moment, I think there is not enough information to suggest this thing is the most probable thing to do. Can still be a trap, and if you're selling supportive context, that would be absolutely stupid. So today, my first assessment is I'm going to follow my weekly plan. My weekly plan was normally, when we were back then, I thought the most probable would be reaching out immediately to break previous week's low point, which we failed and instead broke previous week's high point. So I would say that right now, the most probable is just to do the opposite, like restoring the plan of this week. This was just excessive market stupid, whatever that is. I think we're going to just break down, reverse, and what I care is whether or not we'll manage to reverse the H1 time frame. Of course, I missed the shot, okay? I missed this. I wish I could have took it, but I mean, I can't trade squeezing context and stuff like that. So I kept my cover. I'm covered. I'm not bullish in the market. I'm just out. But I simply missed the shot to go bearish. So maybe that's the timing the market will take to reverse. And now I'm going to hope for one thing, that the market goes there, but actually after reversing the context will offer a pullback, because if it doesn't, I'm fucking out. And I really goddamn don't like that. I've been putting so much energy into catching this fucking market top. And if that's the way we reverse without absolutely nothing to actually do it, I'll be pretty pissed off. But that's the reality, okay? At least right now, I'm not going to suffer the losses and pullback. So if we do an immediate reverse without any proper signals to trigger it, because the only thing we have is actually a taking profit on the daily chart, still a signal, but out of a double fucking top structure, like technically speaking, you could do any worse than that as a statistical opportunity for reverse. So if that's what the market is going to take, going into the most stupid territory to reverse and actually reversing with the most absolutely stupid structure, like just going flat for a week, overcoming the resistance, testing historical high without going there, and then failing and retracing violently. If that's the reality we live in, fuck me. Okay, it's really stupid, but that's also something that can happen. So right now, be real cautious about the volatility. As long as it remains quite subdued and into the nearby territory we're experiencing right now, there's nothing more than just retracing to supports. Though, remember that we've seen many pullbacks in those trends, even though we're totally exhausted. 1 hour, 15 minute, 4 hour, daily, all of those time frames are totally exhausted. You still can't avoid the facts. The fact is that we do have bullish context, and as long as we do have them, don't be too much bearish. And most importantly, if you sell on support context, you just don't fucking understand a thing about my strategy. So now it's too late. Selling was a few days ago, just had absolutely no signals to do that. So either you think this thing is actually reversed and you reverse without actual proper signals, you got to trade, or you understand that right now, at the current given time, catching up this market stop was absolutely impossible. And now it's too late to get to trade. Okay? So I think we've got more than enough things to get to conclusion right now. All right, conclusion in a few words. Reversing out there makes absolutely no sense. We have triggered daily signals actually on every major indices. The Nasdaq is the one I've told you about in the Discord a few days ago, showing you that the 4-hour charts were highlighting a probable final excessive pattern that might be on the verge to signal today. And if it actually shows up, and if we confirm the 4-hour signals on the Nasdaq, that means party's over. And if party's over means volatility can show up, because it all stands to those 5 to 10 values, totally skyrocketingly stupid high, and all of those things. So if these things terminate, if this party's over, things can rapidly roll out of control. I would be just so fucking pissed off that we do this out of a double substock on the SPX, because in this perspective, the SPX would have been the worst asset to follow in perspective for reverse, because it will actually be the one that will get into the most stupid territory and actually reverse because of others. So if that's the world we live in, I would call that bad luck. Really bad luck, but this thing actually happens. And in that perspective, right now, trading the SPX out of these double top structures feels too dangerous to me. Trading other assets like short selling the Nasdaq and eventually the Dow Jones is things I'm going to consider within the next 48 hours. Oh, actually 24. Well, yeah, within the end of the week. So it's just, I don't know yet. And I just can't sell supportive areas. That would be absolutely breaking all of the rules of my strategy. So following the strategy, even though I think that things can rapidly roll out of control and go from bullish to bearish almost instantly, because if we just have apples and stuff like that breaking out supports, things can rapidly roll out of control. I know this, I feel it, but I can't trade supportive areas just like that, because that would be selling supports. And if the market just reacts out of this, and if this is just a trap, if we're just pull backing on those endless trends, what's the fucking point of selling supports? You're just doing the opposite of what I'm teaching you. So right now, waiting seems the most appropriate thing. If we have to break out trade without accumulation, without ranging, eventually we'll consider this, but right now it feels totally inappropriate. All we have is hints and feelings that these things could reverse, but actual clues, not yet. I first of all want to see the H1 context being reversed, and I would like to see how it reverses. Do we see and build supports out of air, or do we immediately fuck it all up and go vertical to the downside, closing below support context, reversing violently, all of those things? If violence is down the corner, we should see it on the charts, on the H1 charts most particularly. So right now, all I can see on the H1 chart, still a bullish market. I know it can violently reverse. I see early signs on the VIX. I see early signs on yields. I see early signs on junk bonds. I'm still waiting to see, and I'm having a deep look right now at USD/JPY as well. So looking at the risk factors seems the most appropriate thing to do right now, really monitoring them, but being anticipatively bearish right now, not really too soon, and you don't sell supports. All right? So that's the conclusion for the day. Monitoring, not acting. All right? Bye, guys.